G'day everyone, welcome to this weekend general update for the 2nd of June. And the correction that I've been looking for probably 4 to 6 weeks has finally got underway. It was a bit begrudging at the start, as I indicated last week that it would be, but it really got into gear on Friday night, and the Dow was down about 200 points. I still think it's shallow, it's brief, it's just the correction we had to have. It's actually going to be ideal because it's going to set up some terrific trading opportunities. For most of this year, a lot of the highest quality stocks have been trending higher very strongly, and unless you got in early, then there haven't been a lot of really good opportunities. Everything's been a bit expensive, but we're now going to see some really good opportunities come up over the next 4 to 6 weeks. So let's have a look at what happened last week. The S&P fell another 19 points, and as I said, it was always going to be a bit begrudging, but once the market starts to let go, then it does let go fairly quickly. However, Friday night looked pretty technical to me. Most of the damage occurred in the last hour. There was no particular news that spurred it, and also the Russell 2000 index, which is the small and mid cap index, didn't really fall all that much. So to me, this looked like it was just a bit of a technical trigger, and that quite often happens when you've got these sort of corrections in an ongoing bull market, which is what I believe we've got. Now, you'll read over the next few months, I'm sure, that people are going to say, sell in May, go away, the bull market's finished, we're going into a major correction. I just don't believe that's the case at all. I continue to see all the signs as being 2013 and probably into 2014 as being quite positive, and that these corrections are actually a good thing because they allow you to get into great stocks more cheaply. So in my view, the bull market has a long way to go. Now, as far as this current correction goes, I'm not sure where we're going to finish on the S&P. There's two target areas. One of them is between 1600 and 1620 if the trading channel holds. If the price breaks below that trading channel, and that wouldn't be surprising after such a long run, then 1555 is the next focus. So we'll just let the market play out as it is, and show us where that point when we reach it. So let's have a look at the S&P. So you can see back in mid-November we started a very strong and very consistent trend to the upside, and it's been contained within this trend channel. Now, the price of the index, or the value of the index, has been overvalued on the RSI for quite a long period of time. Now you can see each one of these corrections only lasted about a week. They were fairly shallow, and they were pretty brief. At some point there has to be a correction of that larger move. So we've had 1, 2, 3, we've had 4 thrusts to the upside. You've got to get a point where it corrects back a little bit further before it can then resume the uptrend. Now, what I'm unclear on is, will the price just pull back to the bottom of this channel, which would put us somewhere between 1600 and 1620, depending on how quickly it does it. At that point, you'll find that the RSI still won't be fully unwound, which is ideally what I'd like to see. So ideally what I'm looking for is for it to pull back to this level here at 1555, which is where the green box is. So it'll probably be somewhere out around here. That would be perfect, because that will then set up the conditions for a very strong rebound. So I'm kind of hoping the trend channel breaks and we get down a little bit further. This correction maybe lasts a bit longer, maybe 4 to 6 weeks, and then we're in a position to move higher. However, we'll just not try and second guess it, we'll just play it as it comes. But important point to remember, high quality stocks bought well in the Australian market can still go up even though the indexes around the world are still falling. So remember that, it's a really important point. Now, turning to the Australian market, our index fell by 57 points on the week, but it will be down by another 50 points on the open on Monday. I believe that there's another 3 to 5% to come out of the banks yet, and we'll have a look at a chart on that supports that view. And already the major miners, BHP and Rio, are already up by 10%. So I'm not expecting them to just continue to rise rapidly. I think after having gone up 10% and coming into a corrective phase in the market, I believe that it's more likely they'll just consolidate around the levels that they're at now. A bit up, bit down, but probably go sideways for the next month or two. But there is definitely a rotation on from stocks that people chased just for high yield and forgot about valuations, and people now are moving their money out of those high yield stocks because they realise they just got to silly levels of valuation, and money is now moving into growth stocks. And by growth stocks I mean stocks that can consistently and reliably grow their profits at 15%, 20%, 25% a year. They're going to come back into favour. Now I'll just whiz over and have a look at the Australian market charts before I move on to gold. So starting first of all with the ASX 200. So we've certainly been in a consolidation mode since our market really stopped rising around about February, whereas the US market has continued to go up. Now there's a couple of retracement scales here. We've already broken through on the shorter term one. We've already broken 4,900. That happened on Friday night. The next level down on that scale is just under the 4,800 mark. We've also got the support provided by the 150-day moving average. You'll notice the RSI is quite oversold, so I'm not expecting there to be a huge amount more downside in the Australian market. And on the bigger time frame retracement, 47.65 sets up as a retracement area. So that's where I believe we might find support, around the 47.70 to 4,800 area. So in this block in here is where I'm expecting to find support on our index. And the main reason for that is that I believe this is the banks. They're already down 10%, but I believe another 3 to 5% could come out of the banks. That brings them back to the 150-day moving average, brings them back onto the 38.2 retracement. The RSI is oversold. That would be the perfect point, and fundamentally their yields will be back above 6%, and that's the most important thing. Once the bank yields get back above 6%, the money's going to start flowing back in again. So that provides a natural floor in the market. So I believe the banks, another 3 to 5% to the downside. We'll see probably the materials index probably just continue to consolidate around where it is. It's 10% off its lows, but I think I'm not expecting too much downside. So I think if you roll all of that up, a little bit more to the downside in our market, and then probably something of a rebound. But as far as other stocks go, the growth stocks go, if we can buy them when there's a little bit of panic dumping of stocks, as we're likely to see in the next few weeks, then you're looking at some exceptionally good trading and investing opportunities. Now let's have a look at gold. This is on a weekly chart. So if you have a look at the week, it really finished flat. I think it gained $1, but it did spike up to the 14.20, 14.25 area, which I said it needs to close above there. It needs to get above that level to signify that the bottom is in and things are trending up. But encouragingly, and I've been saying this for months now, in fact I've been saying it for years, that there's a very, very common trend, and that is that particularly gold stocks will turn up and turn down ahead of gold, and that occurs anywhere between 2 and 6 weeks. So the fact that we're now seeing gold stocks, so this is a GDX, so you're seeing gold stocks now certainly seem to be consolidating. They've actually turned up in the last week, so they are now just starting to outperform. against gold itself. So it's possible we could see a bit more downside in gold yet, but gold stocks do quite well. Friday night, as you can see, they were down a touch, but not much, and that's pretty amazing considering how far out of favour they've been, and the fact that the US market was heavily sold on Friday night, and the fact that gold stocks were able to hold their ground demonstrates very clearly that there's been a change in sentiment towards gold stocks, and that's what I've been looking for. Let's have a look at the spread chart, or the division chart, that we've been looking at now for quite a few months. You can see that gold stocks have been underperforming gold, so this line has been dropping all through that period, but we now seem to have got some stabilisation, and for the first time since November of last year, this line has now come back up and crossed the 150-day moving average. So to me, and it's actually formed a slightly higher high. So I think it's pretty much a given that gold stocks have now found a base and are turning. The only question in my mind is, will they continue to trend up from here, or will this be a few more months of consolidation before they turn up? So that's what remains to be seen, but I think the worst is over for gold stocks, and we can look for some good opportunities over the next couple of months. So that's it for, oh no it's not, I've got a couple of other slides to show. So gold gained $1. As I said, the short term remains a bit unclear to me, but I think gold stocks have turned. Copper was holding 328, so again, it just defies all the people that are speaking negatively about what's happening around the world. If things are so bad, the copper price wouldn't be holding where it is. Now the oil price slipped a little bit down to 92. This is the copper chart. You can see it fell, but it's stabilized now. And just looking at this from a strategic approach, quarter one is traditionally the strongest quarter of the year. That's when we see the most gains. And that was especially going to be the case in 2013, because all the fears that drove markets in 2011 and 2012 and caused all that horrible volatility, they've now been removed. And that was the fear about a financial collapse in Europe. That's now been removed. So 2013 was always going to be stronger, quarter one is always stronger, and so we've seen a terrific period, particularly overseas. Quarter two is often far more volatile, and we're seeing that now in relative terms. We're seeing more volatility now than we saw in quarter one. Members of our group are positioned extremely well, and the smaller number of trading and investing positions that we're holding are holding steady in terms of price, and the fundamentals continue to look terrific. So members are cashed up for the inevitable panic selling opportunities that are going to come along, and really the next 4 to 6 weeks are particularly exciting, because we've got some fabulous small to mid-tier stocks that are going to continue to be just great performers over the next couple of years. And if you can pick them up when they're suddenly sold off, as often happens, then it makes for very profitable opportunities. The rotation from yield stocks to growth stocks is well underway. Just a bit of a perspective on that. Many people bought into the banks, particularly in recent months, at a time when yields were getting down around 5%, because that was the fashion. Everybody was doing it, so it seemed to make sense. Banks had been rising in price for about 10 months, and people start to adopt the attitude that that's going to continue. So they bought into banks when they were too high. They got a 5% yield, thinking that that was good compared to 3% in the bank. But of course, what's happened in May is that they've lost 10% capital value. And I think in the medium term, that capital value has gone for good. And in the short term, I believe there's some more downside. So people that bought into that fashion, people that bought into that trend, have just lost 2 years worth of yield with probably a bit more to come. So banks could end up being down 15%. That's 3 years worth of yield payments have been forfeited because they joined in with the stampede into yield stocks. Growth stocks are poised to return to favour. Money flows cyclically through the market. It always has, it always will, and you need to know how to be a contrarian to make money out of these sort of things. Just as a perspective, a stock like Apple grows their profit at 20% a year, yet it trades on a price earnings multiple of only 11. Now, we've had high yield stocks in this country where the PE ratio has been higher than the typical average growth rate in earnings. It just makes no sense. So you've always got to come back to the basics, and you've always got to be looking for contrarian opportunities, and that's what we're setting up for right now. So sorry it was a bit long-winded, but we're just entering a really important, really exciting period of the year. So hopefully you'll be able to take advantage of it. That's all for this week. Cheers.